I sit with Bill on the programs committee, and we actually started talking about this in the spring, right after we had the bank failures of Silicon Valley Bank, Signature Bank, and Republic Bank. And it was worrisome. It was, the markets were trying to determine, are we in a banking crisis? I don't know that question's ever been answered. And so I thought we would start with hearing the perspective of all of our panelists, because all of your firms were around in 2008, which was our last major banking crisis, and there's been a lot of comparisons to 2008. So I'd like to hear from our three panelists. You guys were all around in 2008. What's different this time versus 2008? And Tom, you're to my right, so we're going to start with you.
Sure. I mean, I don't think this is similar to 2008 for a number of reasons. I think the asset quality in 2008 was, subprime mortgages and a bunch of CDOs and CLOs, and this is, most of these banks are buying government securities, and it's, SVB was a management mishap with respect to duration on securities. I think underwriting standards today within banks are substantially different than they were back in that time. I mean, I think back then, if a deal didn't work, you added more IO to make the DSCR work, and your underwriting vacant office space is worth more than occupied office space. So the underwriting standards are totally different than they were in 2008 and 2009. In addition, like the Federal Reserve right now is, they're currently tightening or holding rates. Back then, they were cutting rates, a lot of quantitative easing. So there's a completely different spectrum with the Federal Reserve as well as with the employment picture. In America, it's 3.4%. It was 5 or 7% back then. So.
Yeah, I mean, when I think about your first question, are we in a banking crisis? I think we have to kind of move away from that narrative of crisis and, really like lift the hood, peel back the onion on the strength, the stability, and the diversification of the financial institutions that you're banking with. So from my perspective at Bank of America, we have a $3 trillion balance sheet. We have $1 trillion in loans, and then we have $2 trillion in deposits. And so that's from all of our 8 lines of business. When you look down a layer and you look at commercial real estate is about $100 billion. So said another way, 10% of loans at Bank of America are commercial real estate. When you look down another layer, specifically at office is 2%. And that office typically is underwritten at, 55% loan to value. It is 75% Class A. So no doubt, there's so many challenges, and we will get through those. But when I think about, the word crisis, the other thing that comes into play are the wall of maturities or the upcoming debt, which is a challenge, right? It's a challenge for a lot of institutions, ourselves included. In a typical year, we have about $20 billion that matures. That typically is about like a 40% payoff rate due to refinancing or asset sales, and we're not seeing that. And so it's no surprise that recycling of capital is not happening, which is causing a lot of institutions not to be able to originate. So when we started 2023, that 40% payoff rate went to about 2%. So again, said another way, 98% of the maturing debt is sticking around, and we're doing the right thing. We're showing up for our clients. We are modifying transactions, but to me, that kind of funnels into the crisis, the headlines, what we're all going through. And then to your second question on how is it different from 2008, 3 things come to mind. Interest rates, vastly different. Leverage, vastly different. But the biggest differentiator for us is our sponsorship. And so the client selectivity and who we are doing business with now are top sponsors, sophisticated sponsors, and people who have been through cycles. So
I don't know what I can add to those two, but I do think 2008 there was an asset quality issue. I think there were asset, as Tom alluded to, they were underwritten off pro forma. We also had the credit default swap market. You had conduits and sort of these non-perfect hedges out there, all these things going on in the capital markets that were derivative-based that really kind of created assets out of vapor. You could securitize a pool of loans, but then you could also underwrite basically insurance on the bonds you just issued and sell that 10 times over. So you could completely recycle every loan you were doing or figure out a derivative based on one asset. And it, as Sam Zell used to say, it's trading sardines. These were not eating sardines. That was 2008, and you also didn't have as much equity in the market. I think since then, obviously, we have a ton of equity that's been invested in these assets, and that's a big difference from 2008, and I think something that's going to help us this time around. I think what we're experiencing right now is really maybe more of a mark-to-market play, where we've all been addicted to low interest rates since effectively the GFC, and then through the pandemic it happened again, that maybe we should have started rolling off on. And I was at a conference in March, literally 1 week before Silicon Valley Bank started, and it was a borrowers conference where they had an old retired Fed governor. He's not that old, actually, he's well younger than I am, but it's a Fed governor from New York. And he spoke to us, and he said, in order to get inflation under check, the short rates need to be higher than the inflation rate for at least 18 to 24 months. And everybody kind of let out a sigh because we knew that the inflation rate was over 5%. And at that point, it was like pushing 6. And so if you think about that and you say, okay, here are these interest rates, that creates an amazing dynamic of a reset on value on, where does capital go? Where can it go get a 6% return when they were building 5.5? Well, now you can go somewhere else pretty easily, and you could have a 3-day trading window for settlement versus, having to invest in something and take months or years to get your value back. So I think that's a huge difference that we're going through right now compared to the GFC, but there's been a lot of equity in the market, but I think we've got a big reset going on right now.
Great. Darcy, I'm going to come back to you for this next one. So you guys were a regulated financial institution, OCC regulated, I believe. And what I remember from the 2008 crisis was there was a lot of banks that wanted to lend or to help their clients, but they were just under a ton of regulatory pressure. And I remember clients that said, well, I've made every payment. Why is my loan classified? And they're like, well, sorry, the regulators classified it. So what are you guys feeling from the regulators right now? Where are they focused in commercial real estate?
Yeah, there's no question there's enhanced regulatory oversight, especially since all of the events of this year. Most recently, at the end of the second quarter, there was new guidance released by the feds on accommodations for any workout loans. And so I think the key point there is that guidance had not been updated since 2009, so for 14 years. And really what it outlines is for financial institutions to be measured and pragmatic when working with sponsors for distressed assets. And it further outlines short-term extensions, partial deferrals, and partial repayment. And then the other piece of regulatory guidance that most everyone probably saw was at the end of July, and the enhanced capital requirements for any institution over $100 billion in assets. And so while that's a proposal, and that proposal would not be enacted until, I believe, 2028, I think overall we know the known is regulatory oversight is increasing. The unknown is exactly what it will effectuate as.
Okay. And Tom and Paul, I know you guys are regulated differently, but I know you also have a really good handle on your portfolios. What are you seeing in your portfolios, and what are you kind of projecting for the next 18 to 24 months as far as any deterioration?
We re-underwrite our portfolio on a quarterly basis, and we re-underwrite our entire multifamily book. And I would say that is holding up very well. On the office side, just nationally, we wrote loans in 2018, 2019 that were office buildings that were underperforming that were going to perform better. COVID didn't help that, and so we're taking a handful of office assets back across the country. I think that theme in modifying office loans is going to continue. We're seeing it on some of our life co book as well, where we're seeing modifying loans that need more time. So I think that's going to continue over the next 18 to 24 months. Other asset classes have all performed really well. Industrial is leased up, and the demand for industrial in Texas is outstanding. And multifamily has done well as well. Okay.
Yeah, I'd say it depends on the portfolio we're talking about. I would say the core portfolio, which many people would maybe call our general account, but it's not necessarily just a general account. that actually, performing very well. I think, I'll just throw it out there. It's the elephant in the room. Every lender that's out there today that knows if they have a loan on an office building, the borrower's choice for recapping that office building is to go back to their lender and try to strike a new deal when that loan comes due, because lenders really aren't trading office assets and saying, "Oh, I'll take out that deal from that lender." It's really more of a musical chairs, and the chairs ran out. But I would say that the portfolio overall has actually performed pretty well. I think supply and demand has been in balance. As you get into the more of the core plus space, and what Tom was saying, that's where he and I compete a little bit in that space, where we're doing floating rate, higher yielding business. Again, I echo that. Yeah, you're going to take back some office deals, or maybe some deals that fell flat, or demand didn't really pan out quite the way you wanted. Either those are going to get a serious recap, or have to be extended, or something's going to be worked out, or they'll be foreclosed upon. But overall, I feel pretty good about it. I don't think those are very few and far between, because the amount of equity that went into the deals originally. And I think some of the equity sponsors realize that maybe with time it's going to heal some wounds.
Okay. I'd say though that we get out ahead of a lot of those deals 18 months, almost 2 years out, and try and work with sponsors on them. And most of them, it's we're not foreclosing; it's due to giving us the keys, and they're putting the flag up and saying we're surrendering. So it's a pretty friendly process.
I think a lot of people learned a lot from 2008.
Yeah.
It does feel like people are much more proactive this cycle than we were last cycle.
And I would add too, our sponsors are coming to us, right?
Yeah.
We're working together, and we're already looking into 2024 and even 2025 in some instances, and people want to talk, and if it's the right time now to go ahead and modify and extend or whatever the situation, we're open to that.
Okay.